All right, good morning, everyone. This is Dean Rogers, Senior Analyst with Kase and Company. Today, one of the things that we're going to be talking about is KaseX. Those of you that are using Kase StatWare, the logic applied here, the signals that are derived for KaseX and Kase PrivateLabel are derived from Kase StatWare and its underlying algorithms. We'll also go through some multiple time frame or multiple bar length trading examples where we scale up and down through time. So there's some good information here for those of you that don't use KaseX. So with that, let's go ahead and get started and just talk a little bit about the signals or the actual plots that we get when we're using KaseX. The entry signals consist of yellow triangles, or what we call darts. In KaseX, we call these darts. In Kase PrivateLabel, these will be diamonds. But nonetheless, the yellow or this gold color is a warning entry. If it's pointing up, it's a warning long. If it's pointing down, it's a warning short. Then we have our short signals, which are our actual short entry and our long entry signals. The short entry signals are the purple down arrow. The long entry signals are the green up arrows. So very simple signals. These are derived from the underlying KCZ entry system that we use in StatWare keys. The entry signals use multiple bar lengths, multiple bar lengths, higher time frame filter, and multiple momentum indicators to generate long and short permissions and long and short trading signals. Momentum signals are, and we use these as exits or profit-taking opportunities, are generated as arrows. The strong signals for bearish signals are down purple arrows. For strong bullish signals are green up arrows. Whenever we see these signals, these strong signals, generally it's an indication that we should take profit anywhere between 50 and 100% of our profit out of the trade. Usually we take around 80% of the profit and pull our stop levels in, which we'll get to in a moment. A moderate signal is a gray arrow up or down. Bearish signal down, bullish signal up. The moderate signals are indications of overbought and oversold. This is periods of time when the market is entered on our momentum indicators, the Case Peak Oscillator and the KCD, into an overbought or oversold situation, and then we have a peak out or a KCD peak, which is a finite overbought or oversold signal that indicates the market is exhausted and that at minimum a correction should take place. And so whenever we see those types of signals, we generally will at minimum pull stop levels in and usually take some profit, maybe 50% profit. They're moderate signals because they don't perform as well as the divergence signals, which are the green and purple arrows, but they are enough of a signal to indicate that we should take some profit out of the trade, and again at minimum pull stop levels in. The weak signals can be either overbought, oversold, or divergences. What happens with the weak signals is basically there is a pattern that takes place that we have studied that dampens the performance for momentum signals like divergence and overbought, oversold, or the peak up and KCD peaks. What happens is whenever we have, let's say for instance, we have a bearish divergence. So we have rising price and falling momentum. To identify that divergence, we have to see a peak in price and a peak in momentum. And they have to take place within a certain tolerance of one another. When the swing high or the peak in price takes place, if the bar that confirms peak, so this is the bar after the swing high, so it's the bar where we know we have a swing high because a new high has not been made. If that bar closes down in the direction of the bearish signal, it's a good, strong signal. That's where we would get the purple arrow down or the gray arrow down. However, if that confirming bar closes up, so i.e. it closes against the signal, we have a bearish signal, but our confirming bar closes up, we will get this light gray, or in NinjaTrader, it's a PrivateLabel, it's a white arrow. And the reason that is those signals from the studies that we've done do not perform well at all. They are still a warning signal. They still indicate that we should pull stop levels in. But Generally, more often than not, those signals fail within a few bars. So if it was a bearish signal, more likely than not, in a few bars, we're going to see the market move back up. So that's why we call those weak signals. As far as the stops are concerned, in KaseX and in Kase PrivateLabel, they have double-sided stops. And so you're basically going to see stops in both sides of the market. We have two different stop levels, stop 1 and stop 2, and then we have opposite stop 1 and opposite stop 2. And really there's not a big difference between these other than the normal stops. The stop level 1 and 2 are going to be in the direction of the trend. So if the market is rising, they're going to be below the market, and the opposite stops are going to be above the market. And then vice versa for a long market. So just to give you an example of what this looks like on the screen, we have our short warning signals. Okay, so whenever we see those yellow down diamonds, that's a short warning. A short entry would take place when we get the purple signal. So in this case, we would have gotten short right in here, ridden this move down. Now there is a special signal. This is the moderate bullish oversold signal telling us that the market may turn higher. But it's in combination with this warning signal. We call these in PrivateLabel pierced diamonds, and in KaseX we call them pierced darts. Pierced darts take place when there is an exit signal, one of the strong or moderate signals, in combination with one of the yellow or green or purple triangles. They basically take place on the same bar. Whenever these happen, again, our studies show that this is a very strong signal. In StatWare, this would be the equivalent of getting a bullish divergence confirming on the same bar as a long signal or an L. Whenever we see that, we immediately reverse our position to long. This is a moderate turn threat, the gray arrow, and we have the green arrow here, which is a normal entry. If I had not taken the entry here, if I wanted to be more conservative, really I would have taken it here on this green arrow or green dart. Strong turn threat down. So strong indication of the move down, more than likely hit stop level 1 and possibly stop level 2. Then we get a turn threat up. Here's a weak turn threat, one of the gray signals. So we can see here on this confirming bar, this is the bar that confirms the signal, it closed up. That's why this turn threat is negative, or I mean is weak. Where here, this bearish signal, the bar closed down, just barely, but it closed down, that's why it's purple. This one closed down, that's why it's gray. This one closed up, that's why it's gray, the darker gray, and so on. Here we have a green turn threat, okay? So this is a strong bullish turn threat where the confirming bar closes up, and so on. And then we have our opposite stops and our stops in the direction of the trend, okay? So far so good, so pretty easy stuff. Let's look at some examples. I'm mainly going to go through some examples that Cynthia and I have put together for a class that she's going to be teaching. But if we have time, we'll pull up some live charts too and take any questions. So as far as entering on the timing chart, we've talked in the past about using 3 different bar lengths or 3 different time frames. Now I'm going to use minute bars in this case because it's very simple. I don't think I actually have any examples of range bars or case bars or anything like that, but again, if we have time, if time warrants, we'll look at some case bars on Bloomberg and multiple time frames there. But the idea behind multiple time frames is that we can scale trades up through time to ride a trend. The goal with Kase StatWare or any of our trading software is to basically time an entry and then ride a trend. We want to try to swing trade it, or really trend trade as much as possible. Now, that comes with a whole other conversation about what is holding periods, what's the best bar length. Really there is no best bar length. The best bar length is what your risk wants, at least with our system. I know that there are some systems out there that are built to be used on certain time frames. They're curve fit to use certain time frames or certain bar lengths or certain bar types. And that's perfectly fine. If it works, it works. My point is, one of the questions that I get very often, and you guys that regularly attend these chat sessions know that I go on about this, is what's the best time frame to use? That's usually one of the first questions I get anytime I'm doing, I have a trial with anyone, whether it's a retail trader or a professional trader. And my answer is always, it depends upon what your risk appetite is. I can't tell you what the best time frame is. These indicators are built, they're statistically significant, they're built to work on any time length, any time bar, any bar length. They work better in a situation where you get in, you scale a trade up through time, and you ride a trend. That's what they're designed to do. That's the trading style that Ms. Case used when she was a trader back in the 80s and 90s, and that's what she designed these indicators for. Now, that doesn't mean that they can't be used for swing trading or scalping or whatever else. You just have to slightly modify what you're doing and how you're using the indicators in combination with your existing techniques. And those are, again, subjects for another day. The multiple bar length idea is to use 3 different time frames or 3 different bar lengths. That's what we teach and that's what we do. Some people will use 2, some people will use 3, some people might just trade on one chart but then use other bar lengths to assess risk, to assess, well, not so much risk, but assess bias or trend direction. So we typically will use 3 different bar lengths. And usually what you want to do is you want to make sure that your longest or highest time frame is something that you can risk. You can afford the risk on that chart. And the way that we tell that is by looking at these stops and looking at where the second stop level is. Again, this is a method that we've gone through in previous chat sessions, and I will go through again in future chat sessions. But we look at the highest time frame. In this case, our highest time frame or our longest bar length is going to be a 270-minute chart. So once we've assessed that the 270-minute chart is a bar length that will, we can trade because we can afford the risk of a 270-minute chart, we then take a third of that to a 90-minute chart and a third of that down to a 30-minute chart. So our 3 different charts are going to be the 30-minute, the 90-minute, and the 270-minute. We call those the timing, the fast monitor, and the normal monitor, where the timing chart's the 30, the fast monitor is the 90, and the normal monitor is the 270. If you're using any kind of range bar, like case bars, range bars, Renko bars, well, not so much Renko bars, but range bars and case bars, once you find out what your highest time frame is, you can divide by the square root of 3 to get your lower time frames at each level. Or if you start from the lowest, you can multiply by the square root of 3. And again, we'll get into that another day. So let's go through this example here. Trading 1, entering on the timing chart. So we're looking at our 30-minute chart. As the market's coming up, it makes a high. We get a bearish turn signal plus a green or yellow arrow. So we get the short entry signal. It's the pierced dart. We're going to go ahead and go short there. Now, if we hadn't taken a short at that point, if we treated this as a warning, what we would normally do is wait for the pullback in the second signal. And when we get that pullback, we want that pullback to hold the previous swing high. And so we actually see that, well, we get the small pullback here. We get this purple arrow or purple dart. And that's where we actually could also take a more conservative entry. But in this case, we're going to follow our quote-unquote guidelines. We're going to take this pierced dart. We go ahead and go short here. Now that was at 9:30 on January 2nd. You can see as this move down matures, there's lots of places where little whipsaws might take place. We would have an exit signal here. Okay, now I'm not going to get long because of the green arrow. Once I'm short, I'm waiting for, the green triangle. I'm waiting for this green arrow to tell me to get long or to get out of my short trade. So as this move down matures, we might get out here. We might have gotten long and then ultimately gotten out, probably get stopped out, and then get long again. We're going to get out in here where we get these double arrows down, double arrow up. This is warning, telling us to pull our stop level and so on and so forth. So you can see there's lots of different, little whipsaw trades in here. And one of the ways that we can avoid those whipsaw trades is to scale to a longer bar length. So once we get short, and you don't see the stops here, I don't have the double-sided stops on at this point just because they clutter up the screen, but we would hold our stop at the second level and we would ride this move down. But at the same time that we're doing that, we're going to be monitoring our 90-minute chart to see whether or not we get an entry signal there. And when we do, which this one takes place on January 3rd, so the next day at 9 o'clock, When we get that signal on the 90-minute chart, at that point, we now have permission to scale to the longer bar line. So at that time, we're going to scale our trade up to the 90-minute chart, or whatever our normal, or excuse me, our faster monitor chart is. So that middle time frame. Now, a lot of trades we're going to hold on this middle time frame, and again, you can see as this move down matures, we avoid a lot of those little whipsaw trades that we were seeing in this area on the 30-minute chart. Okay, we see this little bump up here. That's this bump up right here on the 30-minute chart, where we would have had a couple of trades in here that would have more than likely led to break even or possibly losses. And so this is what we end up with, is a nice smooth transition down. Now again, this is all redundant. I mean, these patterns repeat themselves no matter what time frame we trade. I mean, even if it's a daily or weekly chart, there's still sometimes whipsaws. It's just kind of all the whipsaw and the size of the whipsaws in the eye of the beholder here, or I should say in the pocket or the wallet of the beholder. So as this move down matures, if we're trading with the trend, okay, and this is where, StatWare or these signals aren't going to, the KaseX or any of these indicators, they're not going to tell you whether or not you're trading with or against the overall trend. Because overall trend is, again, something that we perceive, and it depends upon what bar length and what time frames we're trading. Now, when I'm trading on something like a 30 and 90 and a 270, I'm more than likely going to be looking at the 270 and the daily chart to tell me what the trend is. But if I'm trading on a 5-minute chart, 5, a 15, maybe a 45-minute chart, trend might be relative to something like a half-day chart or a 90-minute chart. So that's the point. Now, in this case, if we're trading with the trend, which the general trend, we didn't do any trend analysis or anything beforehand here, but the trend analysis is that the market is declining. And so as this market continues to decline, we're going to watch our 270-minute chart to see whether or not we can scale to a longer bar length or a higher time frame. And so we actually see that here on the 8th at 7:30. Okay, now before that, we hadn't had any exit signals. There was nothing before the 8th of January that would have told us to get out of this short trade. If there had been on the 90-minute chart some sort of exit signal, some sort of green or gray or even these light gray arrows telling us that we should get out, we would have taken those exits on the 90-minute chart before scaling to the 270. But in this case, we get the permissions on the 270 and we scale up to the 270. And you can see again, we avoid all whipsaws and we get a nice clean down move on this 270-minute target chart. Okay. Then ultimately we get our green arrow that tells us that we should get out. Now, you could sit and say, well, why don't you scale to the daily chart? Or why don't you scale to a, whatever, higher, longer bar length? I've predetermined ahead of time that the 270-minute chart is the chart where I can take the maximum amount of risk. I can't trade any bar length that's longer than this, at least without position sizing and doing different kind of things. And, on stocks, on equities, it's a little bit easier to trade the daily chart. But on something like a commodity, it may be a little bit more difficult. So we really have to find that bar length where we're taking our maximum risk. And for me, in this example, on trading target, it's a 270-minute chart. So I'm not going to be able to scale up any higher than this. So this is as high as I'm going to get, and if I get exit signals, I'm getting out. Now, during this entire move down, I'm holding my stop at the second stop level. When I see this exit, I'm going to exit, or this arrow, this green arrow, telling me that I should get out. I'm going to take 80% of my profit. This is on the 5th of February. So just under a month after we had gotten in. So this is a nice long, you don't usually see holding periods that long. But in this case, we got it. And we exit at 55.07. Took a nice little profit, and then we pull our stop level in on the remaining 20% to level 1. Now the idea of exiting in phases is that if this was a false signal and the market turns back down without hitting the first stop level and starts making new lows and giving us new short signals, we're still 20% short from our original entry point. We still have 20% of our trade on from the original entry point, and then we can get back in. Yes, we get whipsawed, but boy, at that point, I'd much rather take some profit and get whipsawed than to have the market turn back up in some crazy manner like it does over here a little bit later on, and get back up so much of the profit that I had made. Now, in this case, a bar later, we do hit we get a long warning signal, and we do hit the Dev 1 or the stop 1, so we're out of the trade. Now, we actually had just had the long warning and the strong turn, so we could, now these are they're not on the exact same bar, but they're within a bar of one another, so that's close enough. If we want to be aggressive, we can enter here when we get this pierced dart. It's offset by a bar, but that's okay. And if we did that, then we would just ride this move up. We would ultimately see this exit, get out, and then so on and so forth. So that's exactly what we do. We get a confirming long signal here, so we're on the normal monitor. We see this moderate exit, so that would tell us that we could take 50% of our profit, pull our stop level into level 1. We do that. We actually hit the dash here, dash 1, and we get out of the other 50%. And then we moderate from that point. We do get a buy signal here, but we did not make a new high that negates this down move. So some might say, well, you got your down move here. Why don't you buy there because you get another green signal? Well, we don't make a new high, so we're not going to take that long. And then the market continues to move down. All right, let's look at this here. Now, at that point, now we're flat, right? We're flat at this point when that stop 1 got hit. So what we're going to do is we're going to start down. We're going to drop back down now to the reversal, to the timing chart. And so when we look at the timing chart, we're going to actually see that we have we had the pierced here, but that was before. This pierced arrow here took place before our exit. So this is our actual second short. Now, in this case, we're showing an alternate exit where we reverse. Okay. What we would have done is, as this move down was taking place, and we were getting ready to hit the stop 1 here, we would actually be monitoring for this reversal signal. So what we're showing here is we're going to reverse. We're going to exit the remaining 50% of the long trade. We're going to get into the short, and then we're going to start the process over. So we basically stop and reverse here on the remaining 50%, and then take a full short position upon this confirming short signal, the second short purple diamond or dart. Then we get the confirming signal on the fast monitor, so we scale to the fast monitor chart and continue to move down. We avoid these whipsaw trades. And then ultimately, we can confirm to the normal monitor. Now, this is a situation, me personally, I would not have scaled this to the normal monitor. And the reason being is, well, actually, no, I would have, because it's a short trade still. So, excuse me for saying that. We've been in a downtrend. This is an upward correction. At this point, I would have taken the short trade. Right? Yeah, hindsight 2020, it'd be better not to scale up to this normal monitor chart. But nonetheless, because at this point, I would have perceived this move up as a corrective move, and then we're getting a new extension to move down, I would have scaled to the normal monitor here upon the confirming purple triangle or dart. Ultimately, we get a green arrow, and so that's an exit of 80%, and we pull our stop into dot 1, and then we're going to show us dropping down, okay? So dart 1 does get hit, but it's hit on the day that we get this big gap, right? Big gap up. But when we exit, when we've exited, one of the strategies is on that remaining 20% or that remaining 50% like we saw earlier, we'll actually drop down to our lower bar length, our timing chart, and time an entry. So we see here that we had a pierced dart, but that was before our exit. We have a pullback, and then we've got some short signals in here, but we're also getting some long signals. And right now, we're looking for that reversal signal to go long. And so that's what we would do here. We could exit the remaining 20%, and we can enter long before we get our gap up. And when we get our gap up, we get a confirming long signal on the fast chart on our 90-minute. So we can scale to the 90-minute. and then continue to ride this move up. Now we get some exits in here. So if I stay on the 90-minute chart, I would have exited part of my trade in here. I would have hit stop 1. Ultimately, I would have gotten long again on this move up, and so on. So you can see there's some more whipsaws. But if we look at the 270, before we get, we actually should be taking an exit in here, and then ultimately getting back in, and then getting back in here, and then ultimately taking 50% out upon this confirming upon this down arrow, and then our exit signal. Okay. So again, I apologize. We lost our internet in the middle there, so we lost some of our rhythm. But if you guys have any, using these multiple time frames, using these multiple bar lengths, and scaling trades up and down across those bar lengths can help us to avoid some of the whipsaw trades. We ultimately, this is a nice clean chart here. Okay, this is a good example where we have a nice clean move down. But you can see we would not have been able to take advantage of this move down on the 270-minute chart if we were trading and holding that position on something like the 90-minute chart where we would have gotten whipsawed a few times, or even the 30-minute chart where we would have gotten whipsawed a few times. And to some people, again, I will get this question a lot. They'll say, well, you look at what if I can only afford the risk of a 30-minute chart? Well, that's fine. You can only risk the 30-minute chart. Yes, you're still going to be taking a lot more trades. You're going to be a much more active trader. But the thing you have to realize is you're also going to be trading lower bar lengths too. So, these repetitive patterns that take place in the market, kind of like a Mandelbrot series, okay? They're just these repetitive patterns. So you get these waves within waves within waves. And so what you're going to be doing is you're going to be timing your trade. If your longest bar length is the 30-minute, you're going to use a 30, a 10, and a 3. Basically taking a third of each, 3 or 4-minute chart. So you're going to time your entry on the 3-minute, you're going to scale it to the 10-minute, and then ultimately the 30-minute is going to be your longest bar length. And so, using these multiple bar lengths can really help us to avoid to hold trades through trends, avoid whipsaw trades, and give us a sense of trading with and against the trend and managing risk. We only take more risk when it's warranted by confirming signals on the longer bar lengths and the higher time frames. So that's what we're really doing. That's what we're really practicing with these multiple bar length approaches. And the way that I do it, and I don't have examples in here, and we'll try to continue to go through examples. I'm going to put together, I just haven't had the time this week, but I'm going to put together an example where we go through some live trading. Now, I can't do live trading, obviously, because the markets don't move fast enough for our short sessions. But I'll do some replay data in like NinjaTrader or something. And what I want to show is when you're trading with the trend, it's great to scale up to your longest bar length, to your highest time frame. But there are times when you're trading against the trend, when you're trading corrective moves. And when you're trading those corrective moves, a lot of times you're not going to want to scale to the longest bar length because then you're taking too much risk. And you're taking a risky trade, a high risk trade. And as you guys have probably picked up, I'm pretty conservative in the approach that I use and that Ms. Case has taught me to use. So in those situations when we're trading against the trend, we're not going to scale higher than the middle time frame or the middle bar length, the fast monitor chart. Okay. So I'll show you some examples of that going forward in the future. As usual, if you guys have any questions, please let me know. Feel free to email them to me, dean@kaseco.com. Let me get my contact and all of our information up in here. dean@kaseco.com. You can also send questions to askcase@kaseco.com, but if you want to contact me directly, it's dean@kaseco.com. Also, feel free to give us a call. If you guys have any questions, we've got a lot of materials up at the KaseStatWare.com and kaseco.com websites. We are also getting ready to open up our forum. I just need to do some testing on it. But we're going to be opening up a forum at kaseco.com here really soon. And it'll have all kinds of great, we'll continue to build that community. So thank you guys for attending. I appreciate it. Thank you guys for watching. I will try to get an edited version of this so that we don't have a big blank area in the middle. Hopefully the recording doesn't get screwed up. and then we'll take it from there. All right? Thank you guys very much. Anybody have any other questions?